Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in. Today, we've got a little bit of a special podcast for you guys where we are going to be talking about oil and gas with two experts from King Operating Corporation, kingoperating.com. Please check them out, Rachel and Tom. But before we get into there, I want to introduce you guys properly. But before that, Paul, tell us, why are we talking about oil and gas today on our podcast?
Yeah, Brandon. Usually we really are focused on commercial real estate, but I think people who follow us and or listen to our podcast on a regular basis know we have a deep belief and commitment to alternative assets as a part of investors' portfolios. And this is an opportunity to push beyond commercial real estate and talk about oil and gas, which is one of the traditional areas in alternative investing. And man, what a time to do that with what's going on in the world. I was on my way to work this morning and heard people talking about the possibility of $200 a barrel oil. So we didn't plan it that way, but what an interesting time to have that conversation. So, today we're going to try to get a good look at how the oil and gas business works, particularly at King Operating, what the returns look like and what the opportunity is. And then hopefully sort of at the end, armed with that information, have a little bit of discussion about where it might fit in your portfolio, particularly if you've been historically really focused on commercial real estate. And we're having this conversation because at the end of the day, it's all about diversity. And although it's what we do every day, it would feel a little bit foolish to simply focus or be so myopic that you think the only valid alternative investment is commercial real estate. It certainly has a place in the portfolio, but I'm super excited to have Tom and Rachel here today to talk about oil and gas and educate our listeners and you and I, Brandon, just a little bit. So it should be fun.
All right. Thanks, Paul. Well, Tom, tell us a little bit about yourself. Give us the 15-second, who is Tom?
I've been with King for 21 years now, been around oil and gas for 35 years. Little bit of everywhere in the field. I do a lot of, talks with potential investors and things like that. But just love the oil and gas industry and love being out in the field. More than I like being in this office, I can tell you that.
Just about everybody I've ever met in the oil and gas business is a lifer. It's been basically what they've done their entire career. So, absolutely. Rachel, how about you? Give us your background a little bit and tell us a little bit about King Operating.
Absolutely. Well, I'm so excited to be with you guys today. And, Paul, we are just loving the opportunity to get on and talk to your audience and share a little bit about oil and gas. And, of course, like you said, alternative assets, they pair so wonderfully together. And being at the Best Ever Conference, it was really fun to just talk with real estate individuals, talk with others who are in alternative assets and how they really pair so nicely together. And as you said, we'll get into that later. But yeah, so I've been with King Operating actually for a year and I absolutely love it. My journey is a little different than Tom's. I was overseas for 14 years and my passion really comes from where I worked before, the lack of energy independence and really what we would call energy poverty really gives me a passion for the energy industry here and also helping investors capitalize on that, take advantage of that, how it brings value to them. So King Operating is an incredible company. It's actually been in business for 30 years. And our CEO, Jay Young, who is a good friend of mine and actually who I met through some of the work I was doing overseas in Africa, and became a donor, actually, to one of the projects that we were doing, is how I got paired up with him 4 years ago. And it was a wonderful connection coming to King Operating. So he's a fourth generation oil and gas man. And so really the legacy of our company is very deep. We've been around for a long time. People like Tom, people like Jay and our operations team have seen the ups, the downs, they've done the don'ts, and now they do, we've got the do's, the don'ts, we've got all the mix in there, which is why I'm excited to talk to your audience and really bring them some value about what do you look for in an oil and gas opportunity? What are the risks? What are the benefits? And how does it really play in your portfolio to bring you value as an investor? So I'm just so excited to be on with you guys today. Thank you.
Yeah, and we definitely are going to dig into that, Rachel. And you guys either one can take this question, but just real quickly, what's different about King Operating's approach from other oil and gas sponsors that may be out there that people could consider? What makes you guys a little bit different?
Yeah.
Rachel?
Okay, sure.
Either way.
Well, honestly, we're very different. And that's part of our journey here at King Operating is coming from traditional oil and gas, which just to give you a quick overview, right? So in a majority in all the oil and gas deals that we know that are available to retail investors, accredited investors, is traditional models allow you to take part in the production of one well or a group of wells. And really all you're going to receive is a tax benefit and monthly or quarterly income. The reason why King Operating is so different is that our deal is actually structured much like real estate. We actually use an acquire, develop, and divest model that actually looks at acquiring high quality mineral leases where we develop them, prove them up, much like real estate. If you had a house, an apartment complex, or something where you could purchase it, you could scale it up, you could add improvements to it, you would be able to sell that later on for a value. That's what we do in oil and gas. So our partners actually not only take part in the production of one well, but they actually own the mineral lease, the producing well, and what is naturally created in oil and gas, which is called offset wells. Those are called PUDs, proven undeveloped wells. So we allow our investors to actually take part in the entirety of the oil and gas process, not just one producing well or a group of producing wells.
Yeah, and Rachel, that's one of the things that stood out to me when we met at BEC is that it is a lot like what we do. We're developers at AAA Storage, and our strategy is to develop, stabilize, and sell these assets. And you guys really kind of follow the same formula. You buy the mineral leases, you develop the production. Once it's established and you've got those offset wells that you can drill, you've created real asset value that then you can sell on to institutional investors or the large oil companies like Exxon or Mobil or the other guys that are in the game and give your investors both current income and ultimately growth of their capital and return of that capital. So it's a really, really unique structure.
Paul, you got an A+ on... Oh my gosh, Paul paid total attention. I am just like A+ to Paul. That was fantastic. It's a concept that made a lot of sense to me. Yep. So let's frame the investment for our listeners for a minute. Give us an overview of the current fund and maybe include a little bit about the timeline from when they invest to when they can expect cash flow and how that might compare to what you know about commercial real estate. And then lastly, maybe hit on some key factors that really drive success or failure, in your structure. One of them is the box is already checked, right? You want an environment where oil prices are rising, and it certainly appears with what's going on in the world today, we've got that in spades. But anyway, give us a little overview of the fund itself.
I'll take this one. Rachel kind of explained our methodology, acquire, develop, divest. This current fund is a $125 million fund. We're about, I think right now, about 80 million through it right now. You mentioned, as far as money going out, we started the fund in November of 24 and started sending out revenue in May of 25. We've grown that from 5.5% up to 11.4% monthly annualized returns as of last month. And that was at between $60 and $65 oil. So right now we've just tacked on $20, $30 a barrel. With the prices going up, which is going to be really nice for our investors. Is that the...
I want me to add on a little bit, Tom?
Yeah, absolutely.
Yeah, absolutely. So like Tom said, our current opportunity, you asked about some of the timelines. So for us, this opportunity, and I'll start here, Paul, because I think this is important when someone is kind of looking at an oil and gas opportunity, right? Oil and gas is notorious for this word we call risk. Risk, right? It's the word that sticks in a lot of people's mind because when they think about oil and gas, they often think about the dry hole, this looming word of the dry hole, which honestly, throughout a lot of the drilling in the 80s and the 90s Tom was a part of. I was being born, but Tom was a part of. I'm just joking, Tom. I'm just joking, Tom. I'm not that young. But during the 80s and 90s, honestly, the way that drilling was done, and Tom can talk about this even more, is they were drilling vertical wells. And so you can imagine that if you have layers of source rock, right? These are the hydrocarbon layers within the rocks and the geology. And if you're basically taking a straw and you're going straight down through those rocks and that geology, you can imagine you're trying to hit one of those source rocks just right there. Well, the chance of actually hitting was so difficult that's why you had a lot of really people become burn victims, is what we called them in the past, when they invested in an oil deal and they just got nothing back. So a lot of what has changed in the oil and gas space is actually the incredible technology and the way that they actually now drill, which is through horizontal fracking. And with seismic, where they're actually basically going and able to see down into the basin, see the geology. So now when they're fracking, they're going down and straight in to that layer of source rock. And that absolutely changed the dynamics for oil and gas. And it helped de-risk oil and gas in a huge way. So really, when we talk about risk, number one, when you're looking at a potential oil and gas deal, you actually want to look at the team track record, right? Who is out there? Are they the operators? Are they buying non-op deals? If you're looking at an operator, you're looking at who's on that team, who's making those decisions, right? 30 years at King operating in oil and gas, there have been quite a few people come through our team, our operations team. And right now I can say we have one of the most incredible operations teams that could be put together. And that's because of experience, right? So when you're getting geologists, geophysicists, engineers, petroleum engineers, landmen, land and business development, these are the gentlemen who are going out and they're assessing, where are you drilling, right? Are you doing exploratory work? Are you wildcatting? Are you hoping to hit it big?
That was one of the things, Rachel, I'm going to stop you for a second, that I was going to add, because my understanding is you're not wildcatting and you're not doing exploratory drilling. You're drilling in the Permian Basin, which is a proven oil field with proven reserves, and that changes the risk profile completely.
You nailed it. That changes the risk profile. So we actually drill in 3 areas. We have Permian Basin, we have the Biven Ranch up in our Amarillo, proven oil field in the state of Texas, and the Anadarko Basin, another widely proven oil field in the state of Texas. So we only work in developmental areas. And if you're assessing an oil deal, you want to look at who in this team is assessing these deals and where are they drilling at? Do you have the track record for the operations team? And how did they assess these deals? How much due diligence did they do on them? What kind of geology do they have on them? What kind of data points from other wells in the area have been drilled? What was the success ratio of other operators in that area? So those are some of the key factors that you can really look at when you're looking at an oil and gas deal. So for us, our operations team, 200 years of combined experience. These gentlemen, many of them have been in oil and gas 40 plus years. And so when they've assessed our deals that we're doing, the areas that we're getting leaseholds on, they are developmental areas with a lot of data and a lot of due diligence on them. So I think I side-railed a little bit there.
No, it's good. But I would imagine you pay a little bit more for the mineral lease in an area like that, because it is in a proven area of reserve. So a little more expensive on the front end, but that additional investment changes the risk profile because of where you're drilling. So it really turns out differently. Tom answered the question about time frame. Sounds like the current fund took about 6 months from inception to cash flow. Do the investors, if an investor, you're $80 million into a $125 million raise, if I were to commit capital to the current offering that you have today, do I come into that pro rata? Do I begin to get cash flow almost immediately, or what's that like for a new investor?
You do. Right now we're in March, so anything that has been done since November of 24, you're going to get paid on that. Not since then, but anything that we do in March, you'll get paid on that in May. We have because we're 2 months in the rears between when we get paid for our oil and our gas. But yeah, the answer is, you get paid on everything that we've done since inception. And especially like right now, you'd start getting, we're expecting 14% returns next month, and no telling what they'll be in May when, if you were to put a couple $100,000 in or whatever, you would be getting that money in May.
Yeah, and this is sort of a very rough way to look at it, but if I understand you correctly, as a new investor coming in, I would get my pro rata share of the income that's being produced from the wells that the fund has drilled since inception. And now the old investors are getting the benefit of new capital that's going to tap new wells, and they're getting their pro rata share. So it actually turns out to be pretty fair at the end of the day. So for a new investor, you're really talking about 60 days from investment to cash flow.
Yes.
The original investors had some ramp up time to get wells drilled and begin production, but the guys coming in now are. What are the key? I want to watch our time because we got some really fun things to talk about, and I don't want to burn up all our time too early. But anything that comes to mind that are key success factors for one of your funds, or things that create problems, that create challenges, that what are the keys to success or failure? Maybe in oil and gas in general. I think Rachel touched on some of those. Choosing the right partners, critical, with the right experience. But within your fund, what are the things that that sort of, if you look back across your history, I'm sure some have outperformed others. What was the difference?
I think the big difference is when we made the move, and matter of fact, anybody that watches this, you can see the book behind Rachel right there, The Upside of Oil and Gas Investing. We changed our model back in 2015 to this acquire, develop, divest model, where the investor partner owns everything in the fund. They own the leases, they own their pro rata share of the leases, any well we drill. That's one of the big things. We've had successes, we've had failures. There's no doubt about that. We drill wells for a living. But we, just for instance, on our Bivens Ranch project, it took us 12 months of due diligence just to finally get an agreement done with the Bivens family. And I'm kind of going off track here, but that's, Rachel, anything to add to that?
No, I think that's good. We did kind of cover some of those, risk factors. I think, the biggest success for us was, having the right team in place and getting the right locations, right? It's all about the team, the locations, and then looking at the fund overall success is that, especially right now, if somebody's thinking about assessing an oil and gas deal, right, is it a producing fund already, or are you giving capital that's going to be deployed a year later? That increases the risk profile by a lot. So for us, some of our key, strong points, I would say, are that we are a producing fund already, so 14 producing wells already online, and then the cash flow factor is really rare. Not everybody can step into an oil and gas deal, and the month they invest, so say it's, like we said, it's March, you're going to get revenue for the entirety of March on the entire fund, and you're going to see that 60 days out. That is really rare, and that's something that we do really to make sure we add value to our partners, that they're getting monthly distributions on that revenue. So that's really something that we're very proud of here at King Operating at this point in the fund.
If you look at in the self-storage business, and you just covered this, so maybe we can move on, but in the self-storage business, when we're looking at a particular site, it's a very hyper-local business. So we're looking at a 3 to 5 mile radius around our site. We're looking at traffic counts and visibility. We're looking at the square footage of self-storage that's available in that market per capita. We're looking at the demographics, the population density, the population growth. Those are the key things that will make a site work or not work. Sounds like there's some similar things in your world. They're just maybe a little more technical, harder for a layman like me to understand, but you're looking at the geology and the history of the other operators that have drilled in that same basin, with good proximity to your leases. Anything else that is a particular way you underwrite and do due diligence to reduce risk for your investors?
That's a great question. Tom,
Yeah,
what do you think? I mean, Paul, I might have you just do a couple of the calls for me with some partners.
I'm sure you've got, with oil prices doing what they're doing today, I'm sure you've got more phone calls than you can handle. But
I do. I'm going to hand some off to Paul. Like, Paul got it. Like, just fucking Paul. He gets the whole thing. No, Tom, anything to add to that? I mean, that was a good recap. What do you think?
Yeah. A big thing now is repeatability for us. We want to go in areas that
Yes.
are that we can do, drill well and know we're going to hit. And with the advent of, not only I've seen it over the years. I mean, I've seen the transition from, drilling a vertical well versus drilling a horizontal well, and then with the advent of new fracking techniques, you're going to hit oil. It's just a matter of how much you're going to hit. But that's one of the biggest things. And 3D seismic. I mean, we have a geoscience guy here that can read that stuff. And like Rachel was saying, I mean, we know exactly it. We've come so far that you're almost steering that bit with a joystick. I mean, it's pretty amazing what they're doing.
That is pretty incredible. I will confess, I've made one oil and gas investment in my life. It was in Louisiana, and it was actually in the very early days of fracking. A law firm down there that I did a lot of business with was in the oil business. A lot of their clients were, and they acquired several wells that production had gotten to a point where they weren't really economically viable, so they'd been capped, and they were able to buy the wells at a fairly low price and then frack them and get the production back up to where it really made economic sense. And it was a very interesting investment, and I did well, but it's the only time I've ever invested in oil and gas. Let's talk for a minute about a couple things. One, I really want to spend time on, but right now you're producing about 11.4%, income or return for your investors from cash flow on a monthly basis. But you also have the end of the strategy where you could dispose of the asset and create a whole different return profile on the growth side. I know you can't predict, and I know you wouldn't try to predict, but what's your target in terms of an overall return? 11.4% on its own isn't bad, but it sounds like these reserves are going to be worth a lot of money in the years to come. And so when you start to exit these positions, what kind of total return profile does that create for investors?
Rachel?
Absolutely. Yeah. So like you said, definitely like for the entire fund, we're going to target 9 to 14% annualized returns. But for us, it's not just the returns, it is the exit. And so for the exit, we actually target a 2.8x multiple. And that is based on, that is actually based on the sale or the divestiture of those assets within the fund. And how we really do that is through kind of packaging what is called a J unit. So that has an existing well, it has the acreage, the lease acreage, and it has the offsets. So those are really where the value is, of course, right? So that you already mentioned it, Paul. We can go at the end of each year and put some of these assets up for sale, see if it is right, and start really getting a return of capital back to our investors in a much bigger way. And then through the 3 to 5 years, as we just continue to scale and sell, that's where we really target that 2.8x. So our project does really, and we haven't even talked about the tax benefits in oil and gas.
We're going there next. That's the next thing I'm going to ask you about.
So I'll just say the 3 real pillars that King Operating really tries to bring value to our investors is number 1, the tax benefit, number 2, monthly revenue and income, and number 3, growth in their portfolio.
That's such an amazing and interesting combination. What is the life cycle? Let's just take the current fund. It's still raising capital. It sounds like you broke escrow in November of 24. I guess at some level it doesn't matter. If I've gotten all my capital back and I'm still getting a return, I don't know why I would care. But is there a expected life of the fund? Is there a point at which you divest all of the assets in the fund, and basically that fund is done. You distribute the cash and you're done, or?
Yeah.
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 Tom?
Our deck shows a 3 to 5 year hold period.
Okay.
We would like to be more on that 2 to 3 year horizon, which gives us the exact amount of time to get the wells drilled, get them online. And you want to try to sell the asset. A well is going to decline before it inclines, obviously. So we want to catch that right at the right moment. And of course, oil prices help as well, natural gas prices. But to answer your question, a 3 to 5 year hold is what we're talking about.
That surprises me. I thought it might be a little longer than that, but that's fantastic. So let's go to the tax benefits. So one of the things that our investors may or may not be aware of, depending on how sensitive they are to tax issues, is there's a fundamental difference in the tax benefits we can create in commercial real estate and that you create in oil and gas. And the difference is simply this. If we produce losses using the bonus depreciation that the big beautiful bill brought back into play, those losses can generally only be offset against passive income, right? And my understanding is in the oil and gas business, that's not the case. That your investors, at least the IDC portion of their tax benefits, can actually be used to offset W-2 or active income. So talk a little bit about that, and probably more importantly, overall, what kind of tax benefits do your investors usually enjoy and should they expect?
Yeah. I'll jump into this real quick.
Okay.
IDCs, intangible drilling costs. The tax law was put into effect during the Reagan administration to encourage more drilling and exploration in the United States. So it's not something that we made up. Typically, you're able to write off between 75 and 85% of what you put into the fund. You can write off any kind of W-2, 1099, capital gains, anything like that. It comes in the form of a K-1. It's a huge, that's what usually gets people's attention to oil and gas first is the tax benefit. And then they learn, oh my gosh, I can get monthly income, and I have a potential for an exit in a 3 to 5 year period. But the Rachel, you want to touch any more on taxes?
Sure.
I just want to clarify something real quick, Tom, for our listeners. So if I made a $500,000 investment in the current fund, I should expect a tax deduction that can be used to offset not just passive losses, but earned income, capital gains of $375,000 for my $500,000 investment. That's 75% of $500,000. Over what period of time would I see that tax benefit?
Mm-hmm.
The first part of it, 85%. We've averaged 82.6% first year tax write-off the last 4 years. The big beautiful bill helped us out as well. We used to amateurize everything on top of the ground over a 5 year period. We'd write it off. Now we're writing it off year one. So that gave us an extra 2 or 3 points right there. But yeah, depending on what tax bracket you do fall in, you're correct. That $300 and something thousand you would write off against any kind of income. Correct.
So the first return that an investor would get would be about $145,000 of tax savings on their $500,000 investment, in the little example I made up here, and then begin to receive monthly income, and then ultimately begin to see return of capital when you start to divest assets. That's a pretty strong combination. Rachel, you were going to add something to that. I interrupted you. So
No, you're good. Well, what I was going to say is, a lot of the difference versus real estate, commercial real estate, and oil and gas is like Tom mentioned, the IRS is incentivizing you to help production. But in order to take advantage of the intangible drilling costs in a operation like ours, you come in as a general partner. So that's one difference. You actually come into the fund as a general partner. What that allows you to do is take those active losses. So you're actually taking an active loss that applies as, like you said, it's going to actually be a deduction on your K1 that goes against any active income you have, whether that's W-2, whether that's short-term or long-term cap gains. And that's really what draws people to oil and gas. Again, we always like to say, don't let the tax tail wag the investment dog, right? You still need to make sure that you're actually investing in a solid program that's not just giving you, it's amazing. You think about, okay, 30%, it's almost a 30% return year one. You can take the bulk of that year one. That's a 30% return, but then make sure that you are in a solid investment that's going to pay out.
Yeah, I tell people all the time, and we're running long here, but we're going to keep going. You'll just have to edit it, Brandon. But the people who do 1031s to defer taxes in a real estate environment, the biggest piece of advice I give them is that paying taxes is better than doing a bad deal. So don't just throw your money at some piece of real estate to get the tax deferral, because you got to make a decision in 45 days. And certainly, I can give money to charities and write it all off. Right. But I don't get any return. So it's important that there are economics attached to the tax benefits. But that's a powerful point of return and benefit for investors in oil and gas. Now, in the time we got left, I want to switch gears, and maybe we need to do a whole nother podcast, because this is what we're really trying to get to. I think we've talked about the environment in your sector right now, and that was one thing we were going to talk about, but I think we can skip over that. If you're fog in a mirror, you kind of have the idea that oil and gas is a pretty good place to be right now with what's going on in the world. But let's talk about the combination of investing in real estate and oil and gas together. And I'm going to do it with what may be sort of a provocative question, but if you had $1 million today, and you were going to allocate between oil and gas and self-storage and small bay industrial, which is what we do, on the development side, we're developers in a different way, but similar to you guys. How would you allocate it, and why? What? And you can both answer, because you might have different answers.
Who wants to go first?
You go ahead.
You want me to go ahead? Well, I love this question, and I know we're short on time, so I will try not to talk long, because I think we're probably running long because of me. But so basically, what I love, again, portfolio diversification, key in any wealth building strategy. Look at what's happening in the world right now. Stocks are plummeting. Oil and gas is rising, right? Stocks can plummet. Oil and gas can go up. Real estate can be solid. Real estate could go down. You have all these ups and downs and cycles. So the best way to protect yourself as an investor and have a great strategy is diversify into different asset classes, right? That is solid investing. If I had $1 million, I would take $500,000. I would put it into King Operating. I would get my tax deduction, and I would start getting my passive income. I would take the other $500,000. I would put it into self-storage, and I'd be looking at a little bit more longer term play for growth, because I know you guys take a little while to ramp up, right? So what I love is having something that gives me a tax deduction, that gives me monthly income, but I also like to have something in my portfolio that I know I can't touch, right? And what I love about alternatives is that you can't touch it. It's not a stock, right? You can't just go, I'm freaked out. You know what? Let me just pull my liquidity out right now. It's stuck in self-storage. You're giving it time to develop. You're giving it time to ramp up, which actually helps you build wealth, and then you have a growth opportunity at the end of that. And that is really one of the best ways that I like to separate my money into different categories.
I think that sounds good. Tom, what about you?
I would totally agree with what Rachel said. Some are, a lot of people are risk averse to oil and gas. Some of them might want to take that $1 million and put 200,000, into oil and gas. And that, I don't know, I talk to a lot of people, and they're like, hey, how much of my portfolio should I have in oil and gas or in alternatives? And, what Rachel said is pretty much on the money. Some people might not want to put that a whole $500,000 into oil and gas, maybe a more tangible asset like self-storage. But, I would agree.
I think this is why, you want to have good advisors in your life. You want to listen to good podcasts like this, because Also, it just depends on people's financial position, where they're at in life, what is their net worth, you know what I mean? How much income do they have coming in? So much of that goes into play in how you want to be positioning your portfolio. I mean, age matters, right? When you're younger, you can be a little bit more risky. You take higher risk. As you begin to get older, you're thinking a little bit more about wealth preservation. You're thinking about your children and your grandchildren, and you're making different decisions based on that. So everybody is in a different place, but I think, you know, alternative assets, what you said is the best thing is owning hard assets is incredibly important to have within your portfolio, especially when we look at market volatility. We look at different things happening in the world. Having a certain portion, you know, you have many buckets in investing. You don't want alternatives to be the bulk of your portfolio, but you do want them to be a portion of your portfolio.
Yeah, and our listeners know, because I talk about this frequently, I'm a firm believer that you ought to have a 40 to 60% allocation to alternatives. And that's on the aggressive end of the scale. And it does tie, as you said, Tom, I believe, to where you are in your journey, in your evolution. During the wealth creation phase, which is generally from age 30 up to about age 55, I think that aggressive an allocation makes sense. But the other opportunity that you have is in both asset classes. You can slide from developmental-oriented opportunities, where there's a little bit more risk and a little bit more upside, to purely income-oriented opportunities in oil and gas or real estate, where you're buying stabilized assets that just produce income. So there's all kinds of ways to structure a portfolio. I wish I had thought to put together a numeric example of what it would look like to invest split $100,000 or $500,000 between what you're doing and what we're doing. And I'm going to do that and send it to you, because I think it'd be fun to look at in terms of the blended tax benefits, the cash flows, and the ultimate growth in your capital by diversifying across these two asset classes. I think absolutely sounds like a smart play, and I want to see the numbers because I'm a numbers guy. But it's been great to have you guys with us today. We're not too much over time, so hopefully folks have stayed with us. But it's been a blast, and so thanks. Give everybody your contact information, and so if they're interested in learning more about King Operating and what you guys are doing, they can get in touch with you.
Absolutely. Our emails are easy. I mean, you can see our names there. Rachel Griffith, so you're just going to go R Griffith at kingoperating.com and T Gray at kingoperating.com. And that's how you can get a hold of us.
That's awesome. Thanks, guys. Really enjoyed having you on. Go ahead, Tom.
Yeah, if you go on our website, there will be an area on there that you can click on to, get more information from us. And just mention in there that you found us on the AAA Storage podcast, please.
Yep. Just type in AE Storage.
Yep, and ours is, everybody knows, our listeners know our web address and know that they can find episodes of the podcast, blog posts, newsletters, and information on our fund at AAAStorageInvestments.com. But thanks, guys, for being with us. A load of fun. Really enjoyed it. We'll do this again.
Absolutely. Thank you so much, guys. Thank you.
Okay.
Thanks, Paul. Have a good one. Thanks, Brandon.
Guys.